So my able professors, you remember that accounting is all about recording business transactions. And I want to believe that you got the definition of a business transaction, right? As transaction as activities that can be measured in monetary terms, right? That is a business transaction for you. Activities that can be measured in monetary terms. And I hope you all remember this definition. Now, what we want to do is that we want to appreciate how these transactions, in a way, impact the asset, capital, liability, expenses, income of a business. But like I've indicated to you, the income and expenses have a direct relationship with capital. So most of the times when those two elements come in, we link it to capital, right? Now, I would want us to state examples of business transactions, okay, and see how we can analyze and determine the impact these transactions would have on our asset, capital, or liability. But before that, I want to do this very realistic or reality check. You are in a family or you have a home where you engage in business transactions, right? Maybe daddy goes to the mall, purchase some groceries, for the home. Sometimes they pay for electricity bills, they pay rent, okay? Those who have vehicles and stuff, they maintain them. So you are aware of business transactions, right? Unless one of my professors here will say they don't know anything about a business transaction. So I want us to look at an example of a transaction in our home or in our family, and then see how it affects us as a family. So who is going to give me that example? Or my professors don't get my question? Just state any transaction that has occurred in your family for us to use to make analysis. And my professors don't want to talk. I'll call one of them. Of Austin, I'll call it Austin. Francis Oklu, you owe me a submission. And I can see Ni Ayibonte too available. So who's going to tell me about any transaction that has occurred in the family? Maybe you did that transaction, or daddy or mommy. Austin, can you share with us?
Buying airtime.
Buying airtime. Okay. So who bought the airtime? Is it yourself or daddy or?
Daddy.
Okay. So thank you for that. So Akoli says there was a purchase of airtime, right? Purchase of airtime, but he didn't give us the amount involved. So let me just assume purchase of airtime, let's say 20 Ghana cedis or 50 Ghana cedis. But please, any other transaction, or better still, let's analyze this one. If Austin has bought airtime 50 Ghana cedis, professors, don't you see that this activity would have an impact on the family? And I want us to brainstorm to discuss that. I don't want to spoon feed you. That's why I'm taking the long, trail of teasing your brains. If you purchase airtime of 50 cedis, how does it affect the family? Prof Ni Ayibonti. I'm sure we've all bought airtime before, so this transaction is very familiar with us. When you buy, what
Yes.
happens?
Say the family loses 50 cedis and gains airtime worth of 50 cedis.
Awesome. Awesome. That is a very brilliant submission, and I love it so much. So you see, the family will be losing money, cash. And as you all know, cash is an asset, right? So if the family is losing cash, it means that our asset is decreasing. But the reverse or the corresponding impact is also that the family is going to gain airtime. And of course, that airtime too will be a resource of the family, right? So another asset will be gained. So if we look at this transaction and want to make a determination of how it impacts the accounting equation or the element capital, asset, and liability, then we can say that this transaction will lead to increase in asset airtime and decrease in asset cash. I believe we all appreciate this. Let's look at the second transaction, and who is going to give me the second transaction? Yes, which professor will give me? Prof. Francis Oklu. Give me a transaction before I come and snatch your ice cream away from you.
Okay, so we did a transaction. We went to send money to a friend of mine.
Okay.
100 cedis. That was 100.
Okay. So in your case, you did a transfer to a friend, right? Was that friend owing you in a way, or is just a normal, gift to the person?
So it was a normal gift.
Normal gift. Okay. Normal gift.
Yes.
Okay. That's fine. So in acknowledging what is going to happen to the family, of course, the family is losing money, right? But in a way, the family is also gaining some kind of friendship on the other hand, because you give the friend some money, the person acknowledges you know, um, and says that, oh, this family is good. So I'm going to also do my best to assist them in any shape or form. That's nice. Now, professors, all these things I've spoken about regarding transactions you make in the family is to make you appreciate that if an activity occurs in a business, okay, and has monetary characteristics, that transaction would impact the assets, liabilities, and capital of the business. And that's what we mean by the effect. So, like based on what we have discussed, you acknowledge that sometimes one asset will increase, another asset will decrease. Sometimes an asset will increase, a liability will also increase, right? So what I'm supposed to do with you, professors, is to list as many transactions that we can and look at how they impact the accounting equation. However, I always take my student through a minimum of 10 transactions. And if they appreciate those 10 transactions, trust me, they become very comfortable with all business transactions they'll face or meet in their accounting career or profession. So we are going to look at 10 basic transactions. I call them 10 basic transactions. And the impact or the effects they have on the accounting equation. Okay. The first one I will take professors through is one, when the owner makes investment. So investment by the owner. when the owner makes an investment into a business? What happens? So let me give an example. I'm starting my Indomie business. I have a car. I have a shop in the market. So I start my business, or I invest these two items in the business. Okay. What impact is this going to have on the asset, capital, or liability of the business? Remember, our point of reference is the business. Okay. So professors, let's discuss. If the owner gives the business something, an asset, okay, what is the impact or what happens? Let me give an example to guide you. So say Mr. Amwa starts a business by investing a building worth 300,000 Ghana. Okay, Prof. Bridget.
Sir, please increase in assets.
So the business would have assets increasing because the owner is giving the business an asset. That's great. So there's going to be increase in asset. Thank you. What other effects would we have? Okay, so I think I'll do that one. So first of all, let's all acknowledge that anytime, okay, I think I see a hand up. The person should go ahead. Who is that? Is that Prof? Prof, please go ahead, unmute and talk to us. Prof, can you take it again? I didn't hear you. Increase in capital. Increase in capital. Wow, I'm beginning to think like you consulted some oracle to get this. But that's awesome. Okay, that's awesome. So, professors, yes, indeed, the effect of this transaction on the accounting equation will be that there will be an increase in assets and a corresponding increase in capital. Okay, now let me explain. So let me take MTN, since that is very common with us. Okay, MTN. So MTN has a lot of owners, right? Or shareholders, if I'm to put it that way. Now, when these shareholders, okay, give MTN a resource or a property, it could be cash, it could be a building, it could be a vehicle, right? MTN as a business will acknowledge that, yes, I'm getting something from my owners. And as we know, anything that is coming from the owners is referred to as capital. So MTN will acknowledge that, okay, I'm getting more capital from my owners, but this capital came in the form of cash, building, or vehicle, and these items are assets. So MTN will acknowledge the asset and also acknowledge that it's coming from owners. So that's why we have assets and what? Capital. So to MTN, its assets would increase and its capital will also increase. Please, does it make common sense to you? Or if you have a question or confusion, let me know. So dear professors, if you are reading a business transaction and you see that the owner is giving something to a business, or the owner has started a business with some resources, remember that Mr. Amwa said that there's an increase in asset and an increase in capital. That is always the case. Just that the asset might be a building, a vehicle, cash, or any other asset, as we've seen, machine, land, etc. Great. Let's go to the second transaction, and that is sale of goods. Sale of goods. Sale of goods. So this is where the business is selling goods. So let's say we have a bookshop, okay, and we are selling the books, right? The stock of the goods that we have. Professors, can you tell me what is going to happen when a business sells goods? What is going to happen to our asset capital? Like, okay, I think I have Prof. Portia, Prof. Eugenia. Prof. Portia, okay, let me call Prof. Portia first on this one. And Eugenia, please be marking time. I'll come to you.
So say when the business sells goods, one, then there will be decrease in his stock. That's the assets, increase in asset stock. And there'll be increase in his cash. That is assets to cash. Yes.
Okay. Awesome. But there's one thing you left out. There's one thing you left out. I wish you could grab that one. Yeah, Portia.
I wanted to ask, what did I eat?
So I'll tell you. Any other version apart from what Prof. Portia said? Okay, so great. That was an awesome submission. That when a business sells goods, remember the goods are the stock, right? And stock is an asset, as we saw. So if we own a bookshop, or if we have a bookshop farm, did I say a bookshop family? A bookshop business. The books there are the stock of goods we have to sell. If we sell the books, then definitely the asset stock or the goods will decrease. So anytime you sell goods, the first effect will be a decrease in asset stock, right? Decrease in asset stock. Now, Prof. Portia indicated that if you sell the books, you definitely get money. Oh,